Good afternoon, good evening, wherever you are. Welcome to this discussion here at the Center for Global Development on the economic prospects and outlook and risks for this year. And I should say it's become a little bit of a tradition now. The World Bank has just produced its Global Economic Prospects report. Ehan Kos is the director of the Prospects Group, chief economist of that part of the World Bank. And I think this is, I believe, the third or fourth year, Ehan, if I've got it right, when you will be sharing with us the main findings and recommendations of that report. And then we have a fantastic group of panelists who are going to give us their perspective on the report, but actually even more on the outlook and risks that we see in the year ahead. And we've got with us Ceyla Pasabashioglu, who's the director of the Strategy and Policy and Review Department of the IMF. We have Hanan Morsi, who's the Deputy Executive Secretary, recently arrived Deputy Executive Secretary of the UN Economic Commission for Africa, having been before that in that other great African institution, the African Development Bank, where she was the Director of Research. And we have Liliana Rojas Suarez, who is a Senior Fellow here at the Center for Global Development and also directs our Latin America initiative. So we have an excellent program for an hour and a bit ahead of us. And to get us started, I'm going to ask Ehan to walk us through the main findings of the report, and then we will turn to our panelists for their initial reactions to it. After that, we will then have a conversation around some issues that come up in that report. And I also look forward to any questions that any of you watching this now would like to send. Please do so, and I will transmit them to our panelists for their answers. So welcome again. And with that, let me turn it over to you, Ehan.
Thank you, Mesut, and good afternoon, everyone. It's great to join really this distinguished group. As Mesut mentioned, we now, I think, establish a little bit of a tradition, and how wonderful that tradition is. We just released the report last week. I'm happy to join this group of exceptional professionals. They have been following the global economy. They are experts. I look forward to the exchange. Let me basically show some slides to have a little bit of a kind of structure and give a sense of what we are trying to communicate in this report and why. I'm hoping that everyone can see the presentation. So the report has the usual global and regional outlooks. In addition to these two chapters, we have three analytical pieces, one on the impact of pandemic on inequality, another one on commodity price cycles, and the third one on the low-income country debt challenges. I'm going to try to briefly mention the results of those. I'm going to focus on three questions. The first one, what are the near-term prospects for the global economy? The second one, what are the main features of these commodity price cycles? And the third one, what are the policy priorities for EMDEs? I'm going to use this acronym EMDs that stands for Emerging Market and Developing Economies. Let me start with the first one. We had a massive global recession in 2020. One of the deepest recessions we had over the past 8 decades. That was followed by this rather strong rebound. And that rebound was actually one of the strongest rebounds we saw after a global recession in a long time period. Global economy registered growth around 5.5% last year. Now, this year growth is going to slow, and next year as well, we will see weaker growth. And that growth slowdown is broad-based. So next year, growth will go down around 4%, and 2021 2023 is going to be around 3.3%. Now, the challenge here, of course, when you look at the advanced economies, they are slowing. When you look at emerging market developing economies, they are slowing. In both cases, we had this exceptional rebound driven by unprecedented policy support as well as pent-up demand. What's going to happen this year and the next year, the policy support is already being withdrawn, and of course that demand is going to moderate. Now, this broad-based slowdown, as much as growth numbers look okay at the global level, comes with one observation we need to keep in mind. It is an exceptionally steep slowdown from a very high base. When we think about how global economy evolved after previous global recessions. So here on the right, you see that, for example, in the last global recession, 2009, global economy made a strong comeback in 2010, but then next 2 years had a sharp slowdown. And this year and the next year, we will see even a sharper slowdown in global growth, and it will be the basically the sharpest slowdown in modern era when you compare with the previous 4 global recessions the global economy experienced. Now, when you look at the regions, you see that growth is going to slow in several regions. In East Asia and Pacific, rather sharp slowdown, mainly because of China coming from a very high number in 2020, and then, of course, going down this year. And then when you look at Europe, Central Asia, Latin America, and the Caribbean, we will see sharp slowdowns. These economies basically have been withdrawing the policy support already, especially in the context of monetary policy, along with fiscal policy. In the case of Middle East, North Africa, and Sub-Saharan Africa, numbers look improved relative to our June report, primarily because of the improvements in commodity markets. In the case of South Asia, India has delivered a better number than what we expected, and that pushed the numbers up. Of course, when you think about Middle East, North Africa, when you think about Sub-Saharan Africa, and you think about Latin America, Caribbean, these are not the numbers basically these regions can deliver in the sense that if they would like to converge to income levels of advanced economies, they need to deliver much better numbers, and those numbers are not there. There is another important observation about this recovery. When you think about advanced economies and emerging market developing economies, yes, they're both slowing, but they're on different flight paths. Advanced economies are going to go back to their pre-pandemic trend level of output by 2023. Emerging market developing economies are going to be 4% below that trend level of output they had prior to the crisis. But more worryingly, when you look at fragile countries, when you look at small states, recovery is much weaker in terms of taking these countries to the level of output we were hoping prior to the pandemic. And of course, ultimately, investment is critical. And their investment dynamics suggest this separation in terms of flight paths. Advanced economies, as I said, flying high, they're going to go back to their pre-pandemic level of investment. Emerging market developing economies are going to see stalled investment levels, and that will continue during the next 2 years, probably beyond. Now, one of the chapters we have looking at this issue of the impact of the pandemic on inequality. One way of thinking about it, what happened to inequality between countries? And there is a huge difference between the pandemic global recession and the recession we had in 2008 2009 associated with financial crisis. After 2009, in fact, inequalities declined in these emerging market developed economies relative to other countries. But now, pandemic was all about inequality, and this weak recovery translates into larger inequality between countries, given that these countries are not delivering the type of per capita growth rates for them to catch up with the income levels of advanced economies. In fact, in many cases, what we see is, rather than convergence, pure divergence. Poverty levels increased because of the pandemic. As you see in the middle panel, millions joined the rank of extreme poverty. And when you look at within country inequality, there has been a significant change there as well, relative to what we saw during the past 2 decades. For the first time, we saw an increase in within country inequality, and that wasn't basically an unexpected outcome, in the sense that, of course, the very large job losses, especially in informal sector, especially the poorest segments of the society. This pandemic was all about those who have the means to deal with the pandemic and those who do not have the means to pandemic. And then, of course, within countries, especially in the case of emerging market developing economies, low-income countries, we are seeing a much worse picture when it comes to inequality. Against this background, there are significant downside risks. And because of those risks, we think that there is a possibility of hard landing in emerging market developing economies, primarily because of these economies really do not have the policy space to counteract the headwinds if some of these risks materialize. The first important risk is still the pandemic, new outbreaks and new variants, as we are going through the Omicron wave, the largest wave actually we have seen so far. The impact of Omicron on global economic activity in our baseline is quite minimal. We think there will be an impact in the first quarter, but there will be recovery in the next quarter. But there is a possibility we have a protracted the outbreak associated with Omicron in different parts of the world. If that materializes, health systems become under pressure, and there are deeper supply side disruptions that could translate into a larger decline than what we are envisioning in the baseline. And that decline could be anywhere between 0.2 percentage points to 0.7 percentage points at the global level for this year. Inflationary pressures, another major risk that relates to, of course, the financial stress, especially highly indebted emerging market developing economies, which I am going to discuss. One of the side effects of the pandemic is persistent supply disruptions. And those disruptions can intensify because of the Omicron wave. And of course, if they intensify, they put additional pressures on prices and inflation numbers. Climate-related disasters are now a part of the risk picture, and they could also create quite a bit of damage. And of course, over the long term, we are worried about weaker long-term growth prospects. Let me briefly talk about one important risk. Inflation numbers, of course, surprise on the upside, as you see on the left. Because of that, financing conditions have been already tightening in emerging market developing economies. This has been partly because of withdrawal of monetary policy I will discuss soon. The big challenge in this year for emerging market developing economies, how they are going to adjust their policies given the basically tightening cycle they are going to face in advanced economic monetary policies. As you see on the right, in the case of Fed, interest rate expectations picked up quite a bit relative to where they were in July. And in all likelihood, we will see multiple interest rate increases, more than what we were thinking in July. And of course, the more, in a sense, intense change in the landscape of financing conditions. Let me briefly talk about the commodity cycles. And there, the almost two-thirds of emerging developing economies are commodity exporters. Some of them pretty much live and die with commodity revenues, as you see on the left. In the case of oil exporters, when you look at the kind of the aggregate numbers, give and take around 60% of their revenues come from the commodities and the oil exports. Over the past 2 years, we had this exceptional boom-bust cycle in commodity markets. Nowadays, oil prices, for example, reached 7-year highs. There are different reasons for that, but on both demand and supply side. During the pandemic, we saw a sharp collapse in oil prices as well as in other commodity prices. In addition to oil, many commodities saw record increases in prices in a short time period. In the report, we have this chapter looking at the entire space of commodity cycle since 1970 for many commodities. One important result is that as much as these booms and bust periods pretty much have the same duration, booms translate into much larger increases in absolute terms than slumps, what we see during the periods of basically bust in terms of prices. So you have during the booms very steep increases in prices, but slumps tend to lead to smaller declines relative to what you see basically during these boom periods. And this has an important policy implication when you think about how commodity exporters need to adjust their fiscal policies. It's going to be absolutely critical to take advantage of these booms to smooth the business cycle during this bust period. So what are the policy priorities for emerging developing economies? They need to find ways to ensure green growth, resilient growth, and inclusive growth. How they are going to do that? I think the first priority still is controlling the pandemic. Equitable vaccine access is critical, and reducing the threat of new variants. But that starts with vaccination of everyone, everywhere, as quick as possible. And the global community has still some miles to deliver the necessary amount of vaccines to remote corners of the world. In low-income countries, vaccination rates still in single digits. Beyond that, communication of policies, credibility of the policies going to be critical. And of course, committing to medium-term plans in an environment, policy withdrawal is pretty much everywhere around the world. Policymakers need to find ways, taking care of their balance sheets, making sure that they are responding to inflationary pressures in the context of monetary policy, communicating their policies clearly, and making them as credible as possible. Given the threat of new variants, given the wide range of risks, flexibility is also critical. Now, a quick word about the policy space in these economies. As you see on the left, emerging market developing economies are in a corner when it comes to monetary policy. They have been already raising interest rates to get ahead of the inflation. And now if you take out emerging market developing economies and look at excluding China, interest rates are higher than the interest rate they had during the decade prior to the pandemic. So the recovery is incomplete, but policy withdrawal has started. When you look at fiscal impulse, the accommodation of fiscal policy, there you see also the same picture. Fiscal impulse was a basically boost to growth. Now it is gonna become a drag to growth. And that process has already, in fact, started last year, and it will continue in light of large deficits and debt levels. Emerging market developing economies are adjusting their policies. So on the one hand, growth is slowing. On the other hand, policies are being withdrawn, and in all likelihood, financing conditions are going to tighten. Between these three, emerging market developing economies need to find a way to calibrate their policies, present them credibly, and communicate well, and explain their medium-term plans, how they are going to basically adjust their policies while we have this slowdown. Final word about the debt challenges. Especially in low-income countries, we have a huge challenge. Debt-to-revenue ratio in low-income countries reached higher than 450% last year. We have good experience with debt relief at the multilateral level. In the report, we have this chapter looking at these previous multilateral debt relief initiatives, and the message is simple. Global community has to act fast, and try to find solutions to debt problems, helping these economies to navigate the challenges in an environment. Really, financing conditions are going to be much tighter 6 months from now than what they are today. More importantly, one important lesson of these previous episodes, previous debt relief initiatives, there is no point to postpone the solutions, because postponing the solutions make these solutions even more expensive. So I focused on three questions. What are near-term prospects for the global economy? A pronounced global slowdown is underway before the recovery is complete in emerging developing economies. There are multiple downside risks. When global economy goes through these types of transitional periods, policies are withdrawn. Accidents can and do happen, and policymakers need to find ways to eliminate or mitigate the risk of those accidents. The second issue is main features of commodity price cycles. I mentioned this booms being larger than slumps. That has an important message for policymakers, how to take advantage of these booms. And of course, given the kind of the energy transition we are going through, these cycles are going to be much more pronounced. So policymakers need to adjust their policies to take advantage of these booms, including the current boom we are going through in commodity markets. And finally, what are the policy priorities? I think the credibility, communication, and commitment and calibration, they are going to be all critical this year. But the first priority is overcoming the pandemic. Let me stop there, Mesut. Thank you very much.
Thank you very much, Ceyhan. That was very comprehensive and very clear. So I think it gives us a very nice space. I want to turn to Jayla next. Jayla, I know the fund's own projections for this year will be coming out shortly, and obviously we'll have to wait until then to get the exact numbers. But I wanted to get a little bit your take on the sort of broad outlook that Ayhan has laid out, and if there are any major differences that are already visible to you from your own thinking. A little bit on the risks as you see them from where you sit in the fund. And Ayhan talked a bit about the policy priorities for the emerging markets and developing economies. I think it'd be interesting also to get your sense on the policy priorities for the rest of the world as it relates to developing countries as well. So let me turn it over to you. Thank you.
Thank you. Thank you very much, Masoud. And it's really a pleasure to be here. Thank you for organizing this and inviting me to be among friends. And another excellent product by Ayhan and the team, and very substantive presentation just now with clear policy recommendations. So it's really a big congratulations, Ayhan, to you and to the team. So let me talk about the perspectives from the IMF, and very much aligned with what Ayhan talked about. In October, we projected global growth of about 4.9% in 2022. We now expect somewhat slower growth than in October because of slowing growth in the two vital engines of the world economy, US and China, and because of the, of course, continuing impact of the pandemic. We will publish the World Economic Outlook update next week, as you mentioned, a bit of an advertisement here. It's a really good work, very substantive as well. You will see all the details and the substantive analysis done by my colleagues. So I'm going to provide, as you said, more of a general update today. As I said, this is a recovery. We are benefiting from the ongoing recovery, which is due to the extraordinary efforts of government, scientists, and essential workers. But it is a very uneven recovery. This is across countries, across regions, and across many different types of sectors and so on, and also with important disruptions. We are facing rough obstacles. Some have persisted for some time now, including very high uncertainty, policy trade-offs, while others are becoming more challenging: COVID, inflation, and debt, which are the three that Ayhan also mentioned. So I'm going to go into detail in each of these. On COVID, the rapid spread of Omicron has led to new mobility restrictions and increased worker shortages. We estimate that the impact of this will be felt, especially in the first quarter of this year. But of course, there's a lot of uncertainty. We don't know what's going to be next. We continue to face the threat of new variants that can create more challenges and further economic disruption. And the big problem that we all face is that 86 countries did not meet the target of vaccinating 40% of their population by the end of last year. This was a big call by the Multilateral Action Task Force on the pandemic, and it will be very difficult for the world to meet the 70% target by the middle of this year. And this requires global coordination and leadership, and it's vital. It's really vital. Pandemic policy is economic policy, so that we can really make sure that we can exit the pandemic and not prolong the dangerous divergences across countries with limited access to vaccines and limited fiscal and monetary space to support their economies. So we estimate that emerging and developing economies will face higher medium-term output losses relative to pre-pandemic trends than advanced economies, as Ayhan also mentioned. And this will mean, of course, potentially more scarring for those countries. Inflation is the second risk I want to talk about, is higher, much more broad-based than expected, with demand side and supply side impact in the US, as well as in many emerging markets and developing economies. This is because of surge in demand, rise in food prices, fuel prices, and of course, continuing disruptions to global supply chains, and the prospects for inflation are very uncertain. And in our baseline scenario, we expect inflation to remain elevated in 2022 before subsiding in 2023. Of course, this is based on the assumption that inflation expectations remain well anchored and that the pandemic eases its grip. But even then, inflation should gradually decrease as supply and demand imbalances subside and economies respond to monetary policy tightening. So the problem here, of course, as Ayhan also mentioned, is the spillovers and impact on other countries. Rising interest rates in advanced economies, even though still low, we are in a low interest rate environment, pose risks to emerging market and developing economies, which have been facing large debt servicing costs. This has implications on capital flows, on currencies, on fiscal positions, especially in countries which are highly indebted. The third risk, which is really an important one, and I upload the work done on the waves of debt, which has this great cover of a tsunami, which I'm afraid is about to come. And we've had extraordinary fiscal measures that helped to prevent another Great Depression, but that has pushed up debt levels in many countries, advanced economies, emerging markets, and low-income countries. We observed in 2020 the largest one-year debt surge since World War II, with global debt, both public and private sector debt, rising to $226 trillion. We just had our global debt product out about a month ago. So we are very concerned, especially about the debt burden in emerging market and low-income countries. One issue here, of course, is the changing creditor landscape. And here, of course, China is an important new creditor, and its slowdown in China and possible retrenchment, which it has been retrenching, means credit crunch for many other countries, especially low-income countries, but not just low-income countries. There's also exposure by quite a few emerging market countries. And that brings me to my last point, which is the unknowns. In response to the pandemic, many emerging markets, actually 84 countries, including advanced economies, but many emerging markets and low-income countries relaxed financial sector standards. So the regulatory standards, which were hard-won after the GFC, are now much more opaque. We don't know what's in, how much of this is reflected in asset quality of financial institutions in many countries. That worries me, and that requires, in addition to some of the policy recommendations Ayhan had, he had macroprudential there. That's really critical, making sure that we do the asset quality reviews in time. I'm sure Liliana may talk about this as well, and do the stress testing, do the preparedness now before we would be hit with concerns and problems on financial sector balance sheets, which always then spill over to the sovereign. Thank you.
Thank you very much, Jayda, and thank you also for raising that last point. I think the history of it is that every time we try and take a policy action which is necessary in the moment, there are consequences down the road, and sometimes we are slow about dealing with the measures needed to address those consequences, and then we end up paying a price for those. So thank you for doing that. We'll come back to that, I'm sure. We've had these two broad global overviews, and I thought we might drill down a little bit into two regions in particular, where I feel the problems are highlighted already by Ayhan very clearly. First being Africa, and I wanted to turn to Hanan. And Hanan, apart from everything else, in some ways, the pandemic is still by no means over for most countries in Africa. So 2022 is not just about Omicron, it's really about the race between vaccinations and the continuation of the pandemic, and that's probably weighing a lot on policymakers. So from where you sit, how do you see the outlook looking out at Africa? And how do you see the disconnect that is beginning to emerge between the advanced countries now wanting to start consolidating, and both on the fiscal and monetary side, you see conditions beginning to tighten. On the other hand, most countries in Africa are at the point where tightening is the last thing that they need. And how do you see that being managed and playing out? So over to you.
Thank you very much. Thank you for inviting me today, and congratulations to Ayhan and his team on the report. Broadly for the outlook, I think, I broadly in agreement in terms of how we see the outlook for the region. Perhaps what I wanted to reflect or give more flavor on are the risks and how they relate to the continent. So, there are risks of current and new waves of COVID that is ongoing. And this is heightened by the lack of equity in access for vaccination, which really hits African countries the most. Then there are the issues of travel and border restrictions that are imposed particularly on African countries by trading partners, which we have seen, which are applied inequitably. So that's another issue. Then you also have the issue of, and Ayhan alluded to it, the risks coming from climate change shocks. And I want to highlight that Africa is the region that is most exposed to extreme weather shocks and climate-related shocks. So add all that to the mix, and you can see, the type of, high risks that really face the continent. Of course, added to this are the issues related to rising inflation, which mostly hit the vulnerable groups, and have potential implication if, as Jayla mentioned earlier, if there is tightening at a global level by advanced economies, central banks, this will have huge implications for Africa in terms of interest rate and ability to finance and rollover, financing condition. And we know from before that when you have higher interest rate environment in advanced economies, we see these capital reversals. So there is a lot of risks that could materialize if this actually happens. So these are some of the risks that I wanted to just give some flavor to. But it's important to remember that as a continent, Africa has huge development needs and huge financing needs even before COVID. And COVID came on top of that. And, one of the most worrying effect of COVID probably is the reversal of hard-won gains in poverty reduction in the continent. So just for 2021, it's estimated that 30 million Africans were pushed into extreme poverty. On top of that, it's estimated that COVID actually increased the number of newly poor in Africa, which those that were above the poverty line, but all of a sudden became below the poverty line by 55 million just in 1 year. That's more than the combined total since 1999. So you can see kind of the gravity of the impact this is having on progress toward SDGs, in progressing in development, and in terms of inclusion and inequalities. Of course, all this is even further complicated by issues that had been mentioned before regarding debt. Of course, COVID led to a surge in financing needs for the continent as governments tried to mitigate the impact, the socioeconomic impact of COVID. This also meant that it eroded their fiscal space, but it also increased their financing needs and led to an increase in the debt level for the continent. So we had an increase from the around 60% per GDP debt in 2019, increased by 10 to 15 percentage points as of last year. So that's significant, increase in vulnerabilities in debt. So all these issues really compound the challenges that the continent faces, and really have implication on what needs to be done both at an international global level, but also at a continent level. So all these issues, I'm sure that we will maybe elude more in terms of what needs to be done on the debt issues. But there is really a lot of intricacies and even more complications of the global situation and its implications for Africa.
Thank you very much, Anand. I think thank you for pointing out also that, in a way, the going in position, even before we were hit by the pandemic, and you highlighted all of the ways in which it's had an impact on poverty numbers, on growth, on setting back the human development, on children that have been out of school, and many of them won't get back into school. I think all this came on top of an already fairly fragile economic situation. And I'm going to turn to Liliana next, but I want to make one point, if I may, which I think applies to both regions, maybe to others, that we've been thinking of these stresses primarily as economic and financial stresses. I think we're beginning to see the capacity of societies to bear this kind of stress for prolonged periods has consequences that go beyond the economic and the financial into the social, into the political. And recently, if you look at the numbers of countries where you've had outbreaks of discontent manifesting themselves, in every case, there is some local specific trigger, but in all cases, there is the overlay that comes from having this now getting on to the beginning of the third year of this enforced extra stress. And now on top of that, I think there is the further pressure that comes from watching on your social media how the rest of the world is coming out of that situation. So 2 years ago, we were all in a stress, but everybody was watching the problem as a shared problem. And now many people in many countries are seeing this as a differentiated problem, and their tolerance for it becomes lower because they don't think it's something that can't be solved. They see it being solved elsewhere. So I do worry a bit about how much during the course of this year we're going to see the problems emerging in a sort of social and maybe even political sense. But I know that's also a worry in Latin America, Liliana. That's why I intervened at this point. But I want to turn over to you to get your take on the region. Also on Latin America as a country, where a set of countries where, if you look at the numbers that IHAN put out, I mean, they are not numbers that are going to make much inroads into either the poverty numbers, but more importantly, into the expectations that populations have in many countries. So what's your take on this?
Thank you, Masood. And first of all, I want to join the group in congratulating Ayhan and his team for another great report. Thanks. Thank you, Masood, for bringing all this topic. Indeed, as the report says, Latin America is showing the lowest growth among developing regions. And this is really unfortunate for the region, especially because it's happening in the context of high commodity prices, which in the past has actually translated into rapid growth and currency appreciation. When we look at recent history, the only period of rapid growth, significant reduction in poverty, and convergence of income towards the level of advanced economies actually occurred during 2004, during the period of 2004 and 2013, which was the last episode of commodity booms. In sharp contrast, this time around, in spite of a new episode of high commodity prices, there's an anemic forecast for growth in 2022, and the local currencies have depreciated significantly. The result, the reason is that the pandemic has exacerbating fragilities, which in turn are resulting in a deteriorated expectations about investment climate. And here comes the point you make. One of the most important fragility is in the area of governance. even before the pandemic, populations in Latin America were very highly dissatisfied with the performance of their governments. And this was evidenced in the eruption of social unrest throughout the region. There were many reasons, and you mentioned some behind this social discontent. Two important ones come to mind, right? The first is the huge deficiencies in the provision of public goods and safety nets. One, well, among several of the recent reports, account that about 40% of workers had no social protections at the onset of the pandemic. And there was growing discontent with the performance of the pension fund systems, especially the private pension fund systems. The second reason was the increasing concerns of populations with the widespread corruption. The famous case of Lava Jato that started in Brazil and spread throughout the entire region is a case in point. Now, in this particular context, Latin America started a process of political polarization with the emergence of political parties, both on the extreme right and the extreme left, and no appetite for reaching consensus. The pandemic has only exacerbated this divide, especially since there were serious mistakes made by the ruling governments. For example, in the management of the lockdowns, in the context of huge labor and firms informality, where the application of advanced economy style lockdowns simply doesn't work. Another big example is in the area of education that you mentioned too, where even now in some countries, students are still not returning to school, not even now, 2 years of no in-person schooling. So you can imagine the losses of human capital that took place during the pandemic. So lack of trust in government, growing populism, and uncertainty about policies are not supportive for investment. So amid a commodity boom, capital flight is now a common occurrence in the region. My own country, Peru, is a clear example of this pattern. In spite of high prices of copper, which is Peru's main export, which has actually helped the fiscal accounts, there is a deep political crisis that is keeping investment down and is fueling large capital flight. So in my view, the legacy of the pandemic is going to be the materialization of another lost decade. At the beginning of the pandemic, there were fears. We were having discussions about the possibility of another lost decade. In my view, those fears are now becoming a reality, unfortunately. Let me stop here.
Okay, so Liliana's kind of brought us to the point where the prospects, at least for Latin America, and that region that she sees are sort of longer term impact. Now, I want to come to the longer term impact in a minute, but just for next year, Ayhan and then Jayla, both of you, I want to get your take on this first. We talked about the risks that come from the tightening in international financial markets, and how big a risk is that, and how much, if you're an emerging market, how much should you be worrying about that part as opposed to other risks? If you're a low-income country, you might say, well, I really didn't have a whole lot of access to these markets anyway, so why do I need to worry? So I want to get a little bit of sense of that. And then from there, I want to segue a bit into the debt issue because the two are linked. But let's talk a bit first about the market access issues. Ayhan, what's your take on that?
Thank you. This gives me an opportunity actually to talk about this risk scenario we are discussing here. And as you know, we always have a risk scenario when we think about these types of vulnerabilities. And this risk scenario in the context of inflation and interest rates starts with this idea, a much faster tightening of the rates because of elevated inflationary pressures. If that happens, this could, of course, trigger a sharp repricing of risk by financial markets and magnifying already heightened macroeconomic vulnerabilities in emerging developing economies. So what follows, if we have this type of course, sharp tightening of global financial conditions, we will end up with a compounded impact of the unwinding of global fiscal support. So we have a slowdown already underway. We have the monetary tightening. It could happen faster than expected. And then you have a fiscal support is being withdrawn at the same time. If that happens, that actually brings us this hard landing scenario. The slowdown would be much sharper in emerging market developing economies than our baseline, because we see negative spillovers through confidence, through trade, through commodity price channels, and that will in turn reduce private sector activity. And then you will have capital outflows. Already these portfolio flows quite small actually, the last year, and we are not expecting much of a change this year. But there will be outflows in response to heightened investor risk aversion, and then that will lead to currency depreciations, which in turn would worsen debt burdens and boost inflation even further. So all in all, you will have a kind of a typical dissolution of financial systems, and then you will have basically outright crisis in some emerging developing economies. In the case of market access, the lesson would be basically it's wonderful to have the market access when there is access out there and the money is cheap, but then markets will come and punish. Unfortunately, they punish those countries, lower income, the developing economies in Africa as well. And some of them, as we have seen over the past 3 months, started feeling the stresses of changing financial conditions. So that brings the issue of, I think, Hanan very gently alluded to, global community has a big role to play to get ahead of these problems, and in terms of putting together a structure, improving common framework. But let me stop there.
Right. Let's come to the common framework in a minute, if we may. Jada, any thoughts on the issue of market tightening? And also, I mean, from where you sit, do you see the impact of this playing out more or less across the board, or to what extent is this something that a few countries that have sort of weaker fundamentals should really be worrying about, but for the other ones, it's going to be a bit more attenuated? How much will the markets, in your view, take into account country policy differentiation at this point?
So, yes, it's not one size fits all. There are some countries which have made a lot of progress. Some countries, actually pretty much across the board, private savings have also increased during the pandemic. So I think it's very much a differentiated picture. But and to the extent that unless we see major asset price dislocations, which is not a low probability event, then there should be differentiation. But I want to point out that there's a lot of correlation and potential asset price bubbles across different equity markets, the digital currencies, which are becoming more of a systemic risk, at least in some countries. So any movement there will have implications much more broadly than, let's say, a disturbance triggered by a specific emerging market in one of the regions, which would, the implication of that would be much more differentiated based on country fundamentals.
Right. Hanan, could I just turn to you for a minute on this issue? I mean, you know, one of the things that people think of when they think of many countries in Africa, they think of the low-income countries that don't have market access that much. But as it happens, actually, a lot of countries in Africa did have market access last year. Sometimes the price that they pay is quite high, and you do worry about the sustainability of being able to borrow on those terms. How much is market access and financial market tightening an issue in where you sit? How much is that taking up the time of policymakers in Africa?
So maybe let's just, I'll try to put it in context in terms of the evolution of debt composition for Africa. Over the last couple of decades, increasingly the share of private and commercial debt have increased, and the availability of concessional borrowing have declined. So that basically pushed many African countries to be able to meet their development needs to tap international capital markets. Of course, with a global environment that is prone to tightening or higher global interest rates, that will definitely impact the cost in terms of the cost of borrowing, the ability to roll over. But very important point to also remember is that there is a bunching of external loan repayments that is coming due for many African countries in the next 5 years. So what happens during that time in terms of the global financial environment and conditions will have huge implication for them. So these issues become really critical for many of the African countries because of the very high share now of private debt and commercial debt, and the issue that there is a huge external loan repayment coming up very soon. So it's definitely an issue that number of countries worry about relative to before. It's not just about bilateral creditors anymore. The landscape has changed massively.
Thank you. Liliana, could I come back to you on this issue? Because one of the things that you and I have talked about is that in Latin America, in addition to sort of sovereign borrowing, corporate sector borrowing has also been rising in a number of countries. And we know from history that when you have a debt crisis, what starts off as private debt often ends up being socialized liabilities, so it does have a consequence at the macro level. If we look at the sort of architecture, well, the risks for countries from this financial market tightening, and you look at the countries in that region, how do you see that how seriously do you think that is a risk for the countries in the region, and how much of this is going to be an issue that works its way through the private sector as much as through sovereign borrowing?
Yes, Masood, thank you. Yes, indeed, corporate borrowing has increased significantly, especially external issuance of debt has increased significantly in the region in previous years before the pandemic. One of the kind of a differentiation of Latin America from other regions, perhaps, is that the central banks have really been very strong. I mean, the strong part, the strong element component of Latin America is in the independence of central banks. And these central banks have been accumulated huge amount of international reserves. And this has facilitated enormously the issuance of debt, both from the government and from the private sector. Because the truth of the matter is that even if private debt were going to be socialized, the international reserve that back up the capacity of a country to pay back the debt is there. It's still there in many countries. Of course, there are exceptions, right? Like we cannot include Argentina or Venezuela in that group. But most of the other countries have a very small ratio of short debt to international reserves. So debt that is maturing in the near future can be paid, can be repaid. So the problem is there, but still this explains why spreads on external debt from Latin America have not increased significantly. It's still quite low. Spreads are increasing, but still are low relative to the risks that are within the countries.
That's a really interesting point. I hadn't really focused on that point. Thank you very much for raising that. So that kind of brings us into debt. And I think we should now talk about debt for the remaining time that we have. And I want to start, Ehan, with you, if I may, because you've talked about debt as one of the chapters here. You talk about how the existing approaches are not as strong or as systemic as previous episodes. That while in history there are many examples of us taking action, the world taking action too late to deal with the widespread debt problems, there's no example I can find where the world acted too quickly in retrospect to deal with that. So I think you've laid this out. So I want to get a little bit your sense of what do you think needs to be done then? What should we do going forward addressing this issue?
Thank you, Mesut. You're asking me this question, but I'm going to mention your latest piece on this one and how you laid out the challenges faced by not just pure low-income countries, but some middle-income countries as well. And of course, Jayla wrote this very informative blog with Kristalina laying out the issues and articulating urgency. Let me just talk about the broader message and what really in the report we try to do. The point of departure is quite simple. Prior to the pandemic, we had a debt problem. That problem magnified now. Global community put forward the DSSI, debt suspension initiative, and that was helpful. But it was a temporary fix. Now here we are talking about a serious slowdown. We are talking about a serious damage in low-income countries, as Hanan mentioned, and of course a tightening cycle that could be even more rapid and larger than what we were thinking of 6 months ago. So, and the G20 has a framework in place with Paris Club, and that's the common framework to address the challenges confronted by these low-income countries, pretty much the kind of the members of IMF. So the big issue is that whether the framework is sufficient in light of earlier multilateral debt relief initiatives. And the answer is that it's good to have this framework, given the creditor base is much more fractured now, and it brings actually these large bilateral creditors to the table, for example, China, and it puts a structure. But so far, it hasn't delivered the kind of the promise. And we have 3 countries in line. There are idiosyncratic reasons why the progress has been slow. But the lessons from the past debt relief initiatives, very clear. Global community has to be more ambitious. And that starts with thinking about how we can improve the common framework, how we can make the common framework ready if we have larger problems down the road than what we envisioned when we set up the common framework. I think that starts with thinking about how we can make the process simpler, how we can make the process faster, and how we can bring these private creditors to the table and think through in a sense, this idea of the common treatment, of comparability of different creditors, and making sure that we are protecting these low-income countries. This does not necessarily mean that we are forgetting creditors have put funds on the table. Their rights should be already also protected. But the historical experience suggests if we do not address these problems, we will have even bigger problems. And I think that one thing we shouldn't forget from the global financial crisis, how certain debt problems in the context of European countries postponed, and they became much more costly to address. In the case of low-income countries, numbers are smaller, but the urgency is much, much larger. But let me stop there, Mr.
Thank you very much, Ayhan. And I mean, it's right that the numbers are smaller in the aggregate, but for the countries themselves, obviously, those numbers are really significant in terms of their implications. So, Jayla, can I turn to you a bit on sort of, I mean, I think your and Kristalina's blog that you did very nicely laid out what needed to be done. And one of my colleagues, I think, is just going to post a link to that blog on the call so people can see it. But I guess my question is sort of, we're now in end of January and the problems are building up. The DSSI has stopped at the end of December. I think it results in I think, Ayhan, your report said $11 billion increase in debt servicing costs this year. How do we get out of this equilibrium that we seem to be stuck in, where people kind of recognize that there's a problem and that needs to be addressed? You've laid out very nicely what needs to be done, but how do we go beyond that and get things done?
So Ayhan mentioned already the four key, and it's in the blog as well, four key issues that would need to be addressed now to be able to make sure that the common framework can be implemented. But I think we need to also step back, and when we talk about the DSSI was liquidity support. It was basically saying, you know, it's suspension of debt service for a period of time. It's not a debt release. And I think what we need to be aware of is the differential impact of the pandemic on different countries, both in terms of their growth outcomes, the limited space they had, and therefore the scarring, and the ability for them to generate enough revenues to be able to pay, to be able to continue with debt service. And if you look at the 73 DSSI eligible countries, about 76, sorry, about 43 applied for the DSSI, because there are also groups of countries which really would like to keep their access to private markets. They have recently gained access to private markets and they do want to keep that. And some of them have been doing really well, really having fundamental changes to their governance frameworks and really making a difference. So I think there's a group of low-income countries which do want to, which are frontier markets and so on, which have the right policies and would like to keep access and therefore did not ask for the DSSI, will not ask for common framework. So that's one group which I think requires from the multilateral community concessional lending to be able to continue and support these reforms. So that's one group of countries. Then there's another group of countries within the 76, which are basically borrowing from multilaterals. And there, again, I think they need grants, they need development finance. So that's what the focus should be on those countries, unless we go for something very different, right? I mean, again, common framework is not going to be relevant for this set of countries, because I find that sometimes we talk too broad brush. There's groups taxonomizing these DSSI eligible countries are important. Then there are countries which have solvency issues, and you see some of them coming to the common framework, some of them have protracted liquidity problems. And let's face it, you have it in your blog as well. You know, Zambia only started discussions recently, lots of reforms going on, but that's recently. So the delays from the common framework is also domestic. Same in Ethiopia, there are issues that we all know. And if you look at the case of Chad, the other country that applied for the common framework, there are quote unquote how do we call them? Private sector creditors, but not financial sector, right? The oil traders, which are very different with different contracts and so on. And again, it brings a level of complexity to the common framework, which doesn't mean, common framework doesn't mean common debt initiative for every single country. It means common set of approaches by the creditors. So the common framework was very innovative to bring Paris Club and non-Paris Club creditors together in the context of the G20 to do case by case whatever is needed for each country. And I think it's dealing with complex countries. None of the earlier debt treatment mechanisms, Paris Club took quite a bit of time to get up to speed and so on and so forth. So I think it's unfortunate that even though this is a good framework, could potentially become very forceful, it's coming at a time of a lot of pressures at the same time. So everyone wants fast, much more, and it's just too many forces are happening at the same time. What does that mean going forward? These elements that need to be put in place, multilaterals should do their job and support countries with reforms. And we should be forceful and bringing new creditors, be it oil traders or financial sector, private creditors, or non-Paris Club creditors, to really coordinate to support countries with the debt treatment necessary. And in some cases, that may mean reprofiling of debt. Thank you.
I think that, thank you for saying all of that, and also for reminding us that the countries' needs are not the same. And I think this is a point that I know that when people talk about whether it's Latin America or Africa, the different countries, we've had sessions here where you've had two ministers from two countries in Africa, one of whom is saying, really need to move forward on debt relief, and the other saying, well, hold on, for debt relief is not really our priority. In fact, we don't want to go there because we want to preserve the market access we have gained through a lot of hard work. And I think the ball then comes back a lot to the IMF and the World Bank, because you are helping to do debt sustainability analyses for each country, which is the place where you do try and lay out what is a sustainable path of financing and where and what kind of debt relief you need. And sometimes, that then there is a journey to be made between arriving in that analysis and getting everybody to agree to it, because it does require some difficult upfront decisions. And I guess as we're coming to closure, one of the things that I wanted to, is very clear to me, is that for this year, these issues around how the debt issue is going to be resolved country by country for different groups of countries within or without, outside the common framework, are going to be very much more center stage. And I know that we just posted the link to the blog that you had done, Jayla, and with Kristalina Georgieva, and also one that Hannah Brown and I had just put out, which sort of goes over some of the same ground. And I hope that soon we'll be able to bring together and have a conversation a little bit more in depth around how we make progress on debt. Last words, any final thoughts from Hanan and Liliana before we close? Hanan, anything from you?
Yeah, I think for the debt issues, I think there's need for action at multiple levels. There is a need for action at a global level to ensure that the resolution is timely, and that things like promoting orderly restructuring and reinforced comparability treatment, which actually the common framework is trying to do. But now is the issue, how do you actually implement and enforce? So there is a really need to have some of these reforms at a global level. But there is also a need for African countries to leverage some legal innovations going forward on things like, collective action and aggregation clauses at a legal level, on a financial level, to introduce things like, value recovery and equity-like debt instruments, and perhaps to consider things like state contingent debt instruments that can link debt service payments to a country's ability to pay. So there is a lot that can be done at multiple levels. There is also a need to have more concessional financing available to help countries that have huge development needs to meet SDGs. So more should be done, and having, something that has also been mentioned earlier, more of blended financing would be key going forward. There has been also the discussion about having this liquidity and sustainability facility that helps countries, the group of countries that actually want and need to maintain their capital market access to do so. There are multiple actions that need to be done both at a global and national level for us to get there.
Thank you very much, Hanan. I think that's very important to point to make, and also the reference to the liquidity and support facility that's there is another mechanism that could happen to provide more liquidity in the market for sovereign bonds for some countries which currently don't have that kind of liquidity, and that might bring in investors who are currently reluctant to come in because of the lack of liquidity. Liliana, your final thought as somebody who has been the mastermind behind all of this panel.
Okay, Masoud, thank you. For Latin America, I see the problem a little bit different. Latin America is among those group of countries that want to keep market access at all costs. They really, and one of the major reasons is because savings ratios are among the lowest, domestic saving ratios are among the lowest in the world. And really there is no other way to go but issuing debt and using external finance. But the problem is that the countries in the region very quickly over and over get over-indebted. So the real question for the region is actually prevention, how to prevent over-indebtedness. And here is where the common framework can actually help, because by having a set of clear rules on how creditors are going to approach a situation of potential default, then perhaps the risk assessment of countries is going to be done much better. Spreads might not be so low in terms of a large availability of liquidity, and over-indebtedness may be prevented. So to me, the common framework comes from another angle, from the angle of prevention. If the cost involved in crisis resolutions are very high, then I will have the incentive in providing, in doing better risk assessment, internalizing the risk of potential defaults much more than they are being now. Right now, spreads actually are not expecting any sort of problems in the region. I'll stop there.
Okay.
Thank you.
All right, so we could continue to have this conversation for much longer, but I think we have run out of time, and I want to thank Ayhan and your colleagues for the work and for coming along and presenting it to us. Thank you for that. And I want to thank Jayla and Hanan and Liliana for your insightful comments. And I want to thank all of you who have tuned in for listening to this conversation. And as I say, there are many issues that have been raised for which we will need to reconvene during the course of the year. Thank you, everybody.